Hello there, this is Utkarsh Jain and we would be looking at the formula review session for CFA Level 2 Alternative Investments. So the first formula would be cost approach for real estate valuation. So in cost approach, we will start with the replacement cost of building. Replacement cost of building. Now we have to ensure that when you calculate replacement cost of building, this has to be inclusive of the profit. Okay, which means on the examination, if you've been given data of the cost of construction and material, make sure that you also include profit into the replacement cost of building. Then once we have replacement cost of building, from this we will reduce the curable deterioration cost. Okay. So for example, let us say replacement cost of building is $12 million, and there is one particular type of deterioration. Let's say the parking lot has some sort of a deterioration issue or some issue with the parking lot. Now because of which your valuation is going to decrease by 1.2 million, but this deterioration could be fixed at a cost of 1 million. Okay, so since the cost to fix that deterioration, which is 1 million, is less than 1.2 million, we would call this as a curable deterioration. And on the exam, if you are provided with these two values, then the amount that you would be reducing is the curable value, which means the lower of the two. So then you would get 11 million, which would be called as replacement cost of building after curable deterioration. Once we've done this, then we will reduce all types of depreciation and obsolescence. Okay, so we will reduce depreciations, we will reduce economic obsolescence, locational obsolescence, then non-curable deterioration of the building. Then this would give us the cost of building here, to which we will add the valuation of the land. And once we have done this, then this would give us the valuation of that particular real estate property using the cost approach. Okay, so moving further for the next formula, highest and best use concept. Now this is a particularly important concept from the exam perspective. Let us say we are trying to value a piece of land, and this land could be used for two purposes. Let's say we can either construct a shopping mall on this particular land, or we can either construct, let us say, a office building. Now if shopping mall is constructed, then valuation of that entire shopping mall would be 50 million, and the cost to construct that shopping mall would be 32 million, which means that valuation of that land is going to be the residual value here, which would be 18. If we decide to construct office building, then valuation of that office building would be, let us say, 60 million, and cost to construct that office building, let's say, would be 50 million, which would give us an implicit valuation of 10 million. Now if you would observe here that valuation of office building is higher, compared to valuation of this particular shopping mall. However, the implied value of land here is higher, and therefore the valuation of that land would be considered at 18 million, not at 10 million, which is the highest and best use concept. Moving further, net operating income. Now the easiest way to remember net operating income formula on the day of exam is to simply imagine this net operating income as a number which is similar to EBIT, which is an operating income. And the moment you say that it is similar to EBIT, what we do not have to deduct is those items that would come after EBIT, and those items would be first interest, and second of them would be taxes. Okay, so let's look at the formula for net operating income. The starting point of the formula would be, you start with the rental income, assuming that property is fully occupied. That means at 100% occupancy rate, to which we will add up other income. Now this other income will typically be made of typically be available in case of the lease is percentage rent lease. Okay, for example, you've signed an agreement which allows you to take some X percentage of I meant to say percentage of sales lease, some X percentage of sales made by the tenants. Okay, so once you have added the other income, then what you'd get after that would be potential gross income. So this is where we have potential gross income. From potential gross income, we will reduce vacancy and other collection losses. So here in the first item in the formula, we assumed what if property is 100% occupied. But on the exam, you would be given, let's say, an occupancy rate of 80%. So then 80% of that rental income would be reduced and we will get vacancy and collection losses. Once we got that, then this number would be called as effective gross income. And from effective gross income, we will reduce operating expenses. Now these operating expenses would typically be property taxes, right, and other type of property maintenance cost. Okay, so we reduce those items, and once we have done that, then the value that you would get is net operating income. Okay, so let's quickly have a recap of this. Start with rental income, then say plus other income, which will give us potential gross income, minus vacancy losses, which will give us effective gross income, minus operating expenses will give us NOI, and what we are not going to reduce is interest and taxes. Moving further, next formula is capitalization rate. So this is now a relatively straightforward formula. In fact, there are two versions of this. First one, capitalization rate would simply be calculated as the discount rate minus the growth rate. Okay, and if you would see, this discount rate minus the growth rate is nothing but the denominator of Gordon growth formula. Okay, and therefore we would simply call this value as the capitalization rate. The second approach through which we can calculate this is NOI of year 1 divided by valuation of the property. Okay, so NOI of year 1 divided by valuation, or discount rate minus the growth rate, would give us the capitalization rates. Next formula would be valuation of property using direct capitalization. So this is an extension of previous formula, or more of an application of previous formula. So value of property, just a minute, value of property at time 0, value of property at time 0 would be equal to net operating income of year 1 divided by the cap rate. And if you would see, the formula is exactly similar to Gordon growth formula, where we say valuation at time 0 is equal to cash flow of year 1 divided by KE minus G, or discount rate minus G, which is the capitalization rate. The next concept is stabilized NOI concept. Now what does it mean? Let us say that you are presented with a scenario like this on the examination, that NOI of a particular property for year 1 is, let us say, 100,000, okay, and NOI of the same property for year 2 would be 100,000. However, there is some temporary construction activity that is happening which will get over, so that construction activity of some part will be over by the end of year 2, and starting from year 3 the NOI will increase to 120,000, and then it will grow accordingly. Now the question is, when you are using a valuation approach, starting from year 3 your NOI is going to increase, and therefore your perpetuity should be applied to this particular number. So what we would do is, we will say that NOI of year 3 is actually, NOI of year 3 is the stabilized NOI, because in the first 2 years there was a temporary construction activity which reduced your NOI. So when you would be performing valuation, your valuation would be 120,000 divided by cap rate, which means you would use the stabilized NOI. But once you've got the valuation, then from this valuation we will reduce present value of whatever was the temporary loss for the first 2 years. Okay, so that decrease in NOI, present value of that amount would be reduced from this particular number, which is 120,000 divided by cap rate, to get the valuation of the property. Moving further, terminal cap rate versus going in cap rate. I intentionally added this number into the sheet based on, because there is one particular question available in the CFA text, end of the chapter question, where you have been provided data like this. Let us say that going in cap rate is 6%. Terminal cap rate is given as 8%, and discount rate has been given as, let us say, 10%. And one of the question is asking you what is the implied growth rate. Now the question is, when you're calculating growth rate, we know that growth rate would be simply discount rate minus the cap rate. But should we use terminal cap rate or should we use going in cap rate? So based on the solution provided for that particular question in the CFA text, your answer here would be 10% minus 6%, which would be 4%. Okay, which means that growth rate would be calculated as discount rate minus the going in cap rate. The reason for this is that this particular number, which is the terminal cap rate, is actually a function of what is the growth rate, let's say starting from year 5 where your terminal period starts, and also what is the discount rate in that particular year. Okay, which means for calculation of terminal cap rate, we are going to use a different discount rate, as well as we are going to use a different discount rate, as well as we are going to use a different growth rate. Moving further, value of the property based on net rent and all risk yield. So on the exam, let us say you've been given data like this. You have been provided with rent, let us say of 100,000, and you have been provided with, now in this rent you are not provided data to calculate NOI, but you've been provided with all risk yield. So the idea is that if you are using NOI valuation approach, then valuation of the property would be NOI of year 1 divided by cap rate. But if you are using rent valuation approach, then valuation of the property would be rent of year 1 divided by all risk yield, which is in a way a proxy of cap rate. But the difference is that here you are not making adjustment for those items when you made adjustment for calculation of net operating income. Okay, so valuation of the property using ARY approaches would be equal to rent of year 1 divided by ARY. Moving further, gross income multiplier. Now gross income multiplier, a straightforward concept. Gross income multiplier would be equal to what is the sales price of that particular property divided by what was the gross income of that property. So this is kind of a simple multiplier type of a formula. And then how do you value the property using gross income multiplier? So valuation of the property using the multiplier approach would be equal to gross income into gross income multiplier. Moving further, term and reversion property valuation approaches. Okay, so we will spend some time on this particular formula. Let's do an example to understand this. Let us say that for the next 2 years, value rent that we can expect from a particular property, let us say, is 200,000. But the current term will get over in 2 years, and third year and onwards, the property rent will increase every year, and now we can expect to receive a rent of 300,000. So the rent which is a part of current contract which has been already signed, this portion is called as the term rent or contract rent. Now let us say the discount rate for this particular term rate is 8% and discount rate for this particular rent is 10%. Now why is it that? Why the discount rates are different? Because since the current agreement is already signed, this is in a way assured cash flow, and therefore risk is lesser, discount rate lesser. Since this amount is based on what would be the market scenario 3 years from now. Therefore, it is relatively more risky, so higher discount rate. So when you're using a term and reversion approach, how would we value this property? First, we will perform the valuation of 200,000 backwards at the rate of 8% for 2 years. So second clear TVM on a financial calculator, 200,000 would be payment. So let me write it here. 200,000 would be payment. Then 2 would be N, because we are going to receive that cash flow for 2 years. So 2 would be N. 8 would be IY. So 8 is IY. And then we will say compute present value. And present value of that amount would come out to be 356,652. Okay, so this is the present value of the term rent. Now from year 3 onwards, your rent is going to become 300,000. So now we have to perform a valuation of that. So we will say 300,000, which is the rent of year 3 divided by 10%. Now since this is a rent of year 3, this is actually giving us a valuation of year 2. So this would give us 3 million as the valuation of this particular property in year 2. And then this 3 million we have to discount backwards for 2 years at the rate of 10%. So second clear TVM, 300,000 divided by 10%, which gave us 3 million. Make this amount as future value, 10 as IY, 2 as N, compute present value, and this value would come out to be 247,9338. So this is the present value of the rent starting from year 3, to which we will add the present value of the term rent, which would be 356652. So let me add it here, plus 356652, and this would give us, okay, I've made some mistake, 247,9338 plus 356652, and this would give us the valuation of property today, which would be 2,835,990. Okay, so let me write down the valuation using term and reversion approach, which would be 2,835,990. Now what if we are being asked to, okay, before I go on to the next point, one very important point here is, since this rent was starting in year 3, the valuation that we would be getting would be of valuation of year 2. Now therefore this amount has to be discounted backwards only for 2 years. On the day of exam, if you by mistake discount this amount backwards for 3 years, which would of course produce you a wrong answer, there is a high probability that that wrong answer would be one of the incorrect options on the examination, and therefore we need to be really careful here, that if your rent is increasing starting from year 3, then the valuation is going to be of year 2, and then we will discount that backwards for 2 years. Okay, now let us solve the same question, but now using the layer approach. Okay, so let me just create some space here. Okay, now how do we value the property using layer approach? What we do is we discount or we divide our rent into two parts. We would say that this 200,000 we would keep on receiving till perpetuity. So 200,000 divided by 8%, this is the valuation of your first layer. So 200,000 divided by 8%, that would give us valuation of 2.5 million. Okay, and so this is the first part, and that increase of 100,000, so that is increase of 100,000. So now we are dividing our layers into two parts. First was that 200,000, and that increase of 100,000 discounted at the rate of 10%, which would give us 1 million. Now the only trick here is that this increase is again the valuation at year 2, because the first rent came in, the excess amount came in at the end of year 3, and therefore this amount we need to take backwards for 2 years. So second clear TVM, 100,000, sorry, 1 million would be future value, 2 would be N, 10 would be IY, compute present value, and that would give us a present value of 826,446, and to this amount we will add up the original 2.5 million, and that would give us a combined valuation of 3326446. Okay, so term and reversion approach, it gave us a valuation of 2.83 million, whereas the layer approach for the same property is giving us a different valuation of 3.32 million. Now the reason why we have different valuations is because in the term and reversion approach, in the layer approach, this 200,000 which was going to come in from year 3, this is discounted at the rate of 8% itself. Whereas in the term and reversion approach, all the future cash flows including this 200,000 be discounted at the higher rate of 10%, which means the same cash flows, since we are discounting or taking present value using different rates for the same property, same set of data, layer approach and term reversion approach are going to produce different results. Moving further, NCREIF property index or NPI calculation. So this is straightforward. The returns that we would be earning, returns earned on property, would be equal to, the first component of return is net operating income plus, so I'm going to write this formula slightly loosely so it becomes more intuitive, plus capital appreciation. Okay, now capital appreciation is nothing but ending value of the property minus beginning value of the property. However, if you define your capital appreciation as ending minus beginning, what if there was some amount of capex invested in this particular year? Then automatically by that amount your ending has increased. So therefore if you say NOI, just a minute, if you say NOI plus ending valuation of the property minus beginning valuation of the property, from which you should also be required to reduce the capex amount and divided by the beginning valuation of the property. Okay, so let's do an example to build better intuition on this. Let us set NOI on a particular property is 100. At the beginning the valuation of the property was 500. During the year we made a capex of 100 on this property, and by the end of the year valuation is 750. Now you start with NOI, which is 100, plus you take the difference between ending minus beginning, so that would come out to be 250. But we know that capital appreciation is not 250 because we have ourselves invested 100, so we will reduce that capex here as a ratio to beginning investment, which would be 500. Moving further to the next question, or next formula, debt service coverage ratio. So in fact we will look at these two ratios parallelly, debt service coverage ratio and the loan to value ratio. Now first let's look at the formula and then we will do an example on these ratios together. Debt service coverage ratio, the formula is straightforward. It would be calculated as net operating income, debt service coverage ratio would be calculated as net operating income divided by debt service. Alright, so and what debt service essentially means is, if it's an interest only loan, then interest would be the debt service, and if it is an amortized loan, then interest plus principal component to be repaid would be the debt service. And how is loan to value ratio calculated? Loan to value would simply be the amount of loan divided by valuation of the property. Now typically if there is a question on this particular formula on the exam, then it would be a combined question, okay, based on how it is presented in the CFA text. So let's do an example to understand this. Let us say that there is a particular property which has got valuation of 1000. Now the maximum loan to value ratio allowed by that particular bank would be 70%. Maximum loan to value ratio is 70%, and minimum debt service coverage ratio, let us say, is going to be 2. Now if the loan is taken, it would be an interest only loan, which will have an interest rate of, let us say, 5%, and NOI of the particular real estate every year is going to be, let me say, this is going to be 60. Now based on this calculation, based on this data, the question will ask you what is the maximum amount of loan that can be taken on this property. Okay, so this question you will have to divide into two parts. The first part of the question, or first part of the solution, would be based on loan to value ratio, how much loan can we take? So we can take 70% of the valuation of property, and therefore based on LTV ratio we can take loan of 700. Based on debt service coverage ratio, what is the maximum amount of interest that we can pay every year? Interest that we can pay, that would be 60 divided by debt service coverage ratio of 2. That means the interest that we can afford to pay every year is 30. Now since your interest rate is 30%, the maximum amount of loan that we can afford to take would be 30 divided by 5%, and 30 divided by 5% would fetch us a valuation of 600. And then we have to choose the lower of the two amount, and therefore the amount of loan that can be taken is 600 based on the data available. Moving further, equity dividend rate or cash on cash return. Okay, so again, relatively easier concept to digest. So let us say that there is a property was worth 1000. Out of 1000, 700 was taken as debt and 300 is taken as equity. Now on this 700 we are supposed to pay an interest of 10% every year. First year NOI, let us say, is 100, or let me increase it slightly. So let's say first year NOI is 150. Now what is the cash which is left for equity shareholder in the first year? That would be NOI minus the interest payment of 70. So cash left to the equity shareholder is 80, and therefore cash on cash return or equity dividend rate would be equal to 80 divided by 300, and 80 divided by 300 would fetch us a cash on, just a minute, 80 divided by 300 would fetch us a cash on cash return of 26.67%.